You have probably heard the rule. Do not buy a home unless you plan to stay for at least 5 years. Financial advisors have been saying it for decades. Parents repeat it. Mortgage brokers mention it somewhere between the paperwork and the handshake. 5 years, the magic number that supposedly makes buying worth it. But here is what nobody is telling you. For young professionals in 2026, in most major cities globally, 5 years is no longer the number. The market shifted. The career landscape shifted. The transaction cost structure shifted. And the people buying homes with the old 5-year math are making decisions based on a formula that no longer reflects the economy they are actually living in. This video updates the formula. Let me tell you about Priya and James. They are 31 and 33. They have been together for 4 years. They rent a 2-bedroom apartment in a major city, Toronto, London, Sydney, it does not matter. This story happens in all of them. And they have been saving seriously for 2 years toward a down payment. They have $85,000 saved. They are proud of it. It has been a disciplined 2 years. The homes they are looking at, not mansions, just reasonable 2-bedroom properties in commutable distance of their work, are listed between $620,000 and $750,000. They run the basic math everyone runs. Down payment check, monthly mortgage payment, manageable if tight. 5-year plan. They think they want to stay in this city. They feel ready, but there are 3 things they have not calculated. The first is how much buying and selling actually costs. The transaction cost layer that exists entirely outside the purchase price. The second is how the 5-year break-even point has shifted in their specific market given current prices and rates, making the old 5-year rule potentially a 7 or 8-year rule for their situation. The third is the career mobility question. James has been approached twice in the last year by companies in other cities. He turned both down partly because the relocation felt too complicated, and partly because the unspoken but very present thought was that they were about to buy. Being house-locked has already shaped his career without him owning a house yet. Priya and James are not making a bad decision by buying. They are making a potentially underinformed one, because the conventional wisdom they are relying on was calibrated for a market that no longer exists. The 5-year rule has a specific origin and a specific logic. Here is where it came from. When you buy a home, you pay transaction costs. These are the costs of the purchase itself that have nothing to do with the value of the property. In most markets, these include some combination of land, transfer tax, or stamp duty, legal fees, home inspection, title insurance, and mortgage setup costs. On the buying side, these typically run between 2 and 5% of the purchase price, depending on your country and city. When you sell a home, you pay transaction costs again. Real estate agent commissions in most markets run between 3 and 6% of the sale price. Add legal fees, staging, potential repairs before listing, and the costs compound. Combined buying and selling transaction costs on a typical property in most major markets total somewhere between 6 and 10% of the property value. On a $650,000 home, that is $39,000 to $65,000 in costs that exist purely to move in and out of the property, before a single mortgage payment, before a single repair. The 5-year rule exists because historically, with typical appreciation rates and the cost structure described, 5 years was approximately the minimum ownership period needed for property appreciation to cover those transaction costs and produce a positive net outcome. Here is why that calculation has shifted. Factor 1. Transaction costs have increased. In many major cities, land transfer taxes, stamp duties, and legal costs have increased meaningfully over the past decade. In cities like Toronto, London, and Sydney, the buying side transaction cost alone on a $700,000 property can exceed $30,000 for a first-time buyer and significantly more for repeat buyers. Higher transaction costs mean a longer period is needed to break even. Factor 2. Price to income ratios have extended the required appreciation period. The 5-year rule worked comfortably when homes were priced at 3 to 5 times annual income in most cities. At that ratio, modest appreciation of 3 to 4% annually covered transaction costs within 5 years relatively reliably. In 2026, in most major English-speaking cities and many European capitals, homes are priced at 8 to 15 times median annual income. At these ratios, the required appreciation to cover the same transaction costs takes longer, and appreciation rates have been more volatile and less predictable. Factor 3. Interest rate environments changed the early year mortgage math. In the low rate environment of 2010 to 2022, a larger portion of early mortgage payments went toward principal rather than interest. This built equity faster in the early ownership years and helped the 5-year math work. In a higher rate environment, a larger portion of early payments goes to interest, not principal. You build equity more slowly through repayment in the first 5 years. The break-even point extends. Factor 4. Career mobility has become a more significant financial variable. This is the factor the traditional 5-year rule does not account for at all, and it is increasingly consequential for young professionals in 2026. The labor market for skilled professionals has become significantly more mobile and more remote-enabled. The best opportunities for income growth, the job change that increases salary by $20,000, the remote role with the international company, the relocation that opens a career trajectory, increasingly require geographic flexibility. Being house-locked, owning a property that is not liquid, that carries significant selling costs, and that ties your financial flexibility to a specific location has a career cost that is real and increasingly large. A salary increase of $25,000 available through a relocation or career move, forgone because the timing of selling and buying makes it too complicated, is a financial cost of homeownership that never appears on any mortgage calculation. Let me show you the real break-even calculation for Priya and James and how it compares to the conventional 5-year assumption. They buy at $685,000. Their combined transaction costs, land transfer taxes, legal fees, inspection, title insurance, come to approximately $28,000 in their market. They put $85,000 down. Their mortgage at current rates carries a meaningful interest component in the early years. When they eventually sell, agent commissions and selling costs will run approximately $35,000 to $42,000 on a property at that price. Total transaction costs round trip, approximately $63,000 to $70,000. For them to break even on the purchase, their property needs to appreciate by at least $63,000 to $70,000 above the purchase price. At 3% annual appreciation on $685,000, that takes approximately 3.5 years of pure appreciation to reach $63,000 in gains. So 5 years should be fine, right? Not quite, because appreciation does not cover the full cost picture. During those 5 years, the interest portion of their mortgage payments, property taxes, maintenance, and insurance represent ongoing costs that a renter in a comparable property would not pay and could instead invest. When you include the full carrying cost comparison, the genuine financial break-even point for Priya and James in their specific market at current prices and rates is closer to 6.5 to 8 years, not 5. If they sell at year 5, there is a reasonable probability they exit with a neutral to slightly negative financial outcome compared to having continued to rent and invest the difference. At year 8, the math clearly favors having bought. The 5-year rule has become a 7 to 8 year rule in many of the markets young professionals are actually buying in. That is not a reason not to buy. It is a reason to know your actual number before you commit. Now here is the alternative scenario. James takes the role in the other city at year 3 of homeownership. They sell. At current market conditions, transaction costs of $63,000 come out. If the property appreciated at 3% annually, they gained approximately $62,000. Their transaction costs slightly exceed their appreciation gain. They exit approximately neutral to slightly negative financially. Had they been renting, James could have taken the role in year 1. The salary increase of $25,000 annually compounds over the following 5 years into meaningful additional income and investment capacity. The house did not destroy their finances, but it did cost them something the 5-year rule never accounted for: career optionality and its financial value. Here is how to run the updated calculation for your specific situation and make the buy or continue to rent decision based on your actual numbers rather than the conventional wisdom. Step 1. Calculate your specific market's break-even timeline. Find the total transaction costs for buying in your city: land transfer tax, legal fees, inspection, title insurance. Research the typical selling costs, agent commissions, legal, staging estimate. Add them together. That is your round-trip transaction cost. Research the historical average annual appreciation rate for your specific neighborhood and property type over the last 10 years. Be conservative. Use the lower end of the range. Divide your round-trip transaction costs by the annual appreciation dollar amount your property would generate. That number is your minimum break-even ownership period, before carrying costs. For a more complete picture, also calculate the monthly cost difference between buying and renting a comparable property. Multiply by the number of months in your timeline. Add that to the transaction costs for a fuller break-even calculation. If your realistic timeline in this city is shorter than your break-even number, the math does not support buying right now in this location. Step 2. Honestly assess your 5-year career and life plan. This is not about predicting the future perfectly. It is about honest probability. Ask yourself 3 questions. How confident am I that I will be in this city in 5 years? On a scale of 1 to 10? How mobile is my career likely to be over the next 3 to 5 years? Am I in a field where significant opportunities require relocation or where remote work makes location genuinely irrelevant? Are there major life changes, relationship status, family planning, career pivots that might make a different location or property type more appropriate in 3 to 5 years? If your honest confidence in 5-year stability is below 7 out of 10, the break-even analysis needs to use a shorter timeline. And shorter timelines make the math harder in most major markets at current prices. Step 3. Calculate the rent-to-price ratio for your target property. This is a quick sanity check that professional real estate investors use and individual buyers almost never do. Take the annual rent for a comparable property. Divide it by the purchase price of the property you are considering. A ratio above 5 to 6% generally suggests buying may make more financial sense than renting at current conditions. A ratio below 3 to 4%, which is common in many overvalued urban markets, suggests the property is priced more for appreciation speculation than for rental income value. In these markets, renting and investing, the difference often produces comparable or better financial outcomes. Example: a property priced at $650,000 that would rent for $2,400 per month has an annual rent of $28,800. Divided by $650,000, a ratio of approximately 4.4%, below the threshold that clearly favors buying. This does not mean you should not buy. It means you are buying primarily for lifestyle stability and speculative appreciation, not because the fundamental income math strongly supports it. Step 4. If buying, extend your minimum commitment timeline beyond 5 years. If after running these calculations you decide to buy, Revise your minimum commitment in your own mind from 5 years to whatever your actual break even number is. This matters because it changes decisions you make during ownership. If you know your real break even is 7 years, you do not take a major relocation opportunity in year 3 without fully understanding the financial cost. You do not list the property in year 4 because the neighborhood changed slightly. You do not make the emotional short term selling decision when the market has a rough quarter. You hold through the events that do not exceed your timeline because you know the timeline. Step 5. If the numbers do not support buying yet, rent intentionally. Renting is not the default passive option. It is an active financial choice that, when executed with intention, can produce stronger financial outcomes than buying in the wrong market at the wrong time. Renting intentionally means capturing the cost difference between renting and owning and directing it to investments consistently. It means maintaining geographic flexibility for career acceleration. It means building the financial foundation, investment account, emergency fund, net worth growth that puts you in a stronger position for the eventual purchase. Renting while building deliberately is a strategy. Renting while waiting indefinitely without building is not. Know which one you are doing. Here is the reframe. The 5 year rule was never a universal truth. It was a heuristic, a rough guideline, built for a specific market condition: moderate prices relative to income, lower transaction costs, predictable appreciation, a labor market where staying in one city for a career was the default rather than one option among many. Those conditions have changed significantly in most major cities where young professionals are actually making these decisions. The rule has not updated to reflect the change. You need to update it yourself by running your specific numbers in your specific market with your specific career trajectory. Buying a home is not automatically smart. Renting is not automatically wasteful. Both are financial tools. Tools work when they fit the situation. The 5 year rule was a shortcut to figuring out which tool fit. The shortcut no longer works reliably in many markets. Do the actual calculation. It takes an afternoon. It involves your real numbers. It produces a real answer specific to your life. That answer, whatever it is worth infinitely more than a rule that was calibrated for someone else's market in a decade that has already passed. Priya and James are going to buy a home. Maybe next year. Maybe in 3 years when they have run the numbers and confirmed their timeline genuinely supports it. Maybe in a different neighborhood where the rent to price ratio makes the math work more cleanly. Or maybe James takes the role in the other city and the flexibility they preserved by not buying, yet turns out to be worth more than the property appreciation they would have captured in year 3 of a 7 year break even window. Both outcomes are available to them because they did the calculation before emotion and conventional wisdom made the decision for them. You can do the same. Calculate your round trip transaction costs. Divide by realistic annual appreciation to find your true break even. Run the rent to price ratio on the property you are considering. Assess your 5 year career mobility honestly. If the numbers support buying, buy with confidence and with a realistic timeline commitment. If they do not, rent with intention, build aggressively, and revisit the calculation in 12 months. The 5 year rule served a generation well in markets that no longer exist. The new rule is simpler and more honest. Know your actual number, then decide. Drop a comment below and tell me, where in the world are you watching from, and where are you in this decision? Considering buying soon, currently renting and building, or already own, and wondering if the timing was right? Tell me your city and situation. I will give you my honest read on whether the numbers likely support the move in your specific market. If you know someone about to buy a home in a major city who has not run this calculation, share this video with them before they sign anything. The afternoon this calculation takes is the most valuable afternoon in the home buying process. Subscribe to NuellaInvests. Every week, we update the conventional wisdom that was built for a different economy and help you make decisions for the one you are actually living in. See you in the next one.